All right, everyone, welcome back to the channel, your number one source for income-oriented investing. I got two special guests today. I got Patrick Somerville, one of the main guys at Hamilton ETFs, but I also have, and we're going to focus a little bit more with Nick this time, Nick Piquard, who's actually the head options strategist, the guy behind, the brains behind all the covered calls and the options at Hamilton ETFs. So, guys, thanks so much for taking the time. How are you doing today?
Our pleasure. We're doing great. It's always fun to be here with you, Adrian.
Yeah, great to be here.
Yeah, so Nick, I hope you're ready for questions, lots of technical questions. We're gonna do a little deep dive really into the options and go into the guts of,
I'm
how
looking forward
Hamilton.
to it. I'm looking forward to it.
Beautiful, beautiful. And there's also some member questions as well we're gonna take at the end. So it's gonna be fun. It's gonna be awesome. So why don't you guys just give me a quick update on what's going on at Hamilton ETFs these days? I know you're hitting milestone after milestone, but is there anything you wanna bring us up to speed on?
Sure. Yeah, it's been hard to keep track of. We've had major growth the last 3 years. I'll just give you just the last year, our AUM grew over 100%. So we're now just shy of 6 billion in overall AUM. So we appreciate you and your followers and all the people that are following our ETFs. Some other milestones, HDIV, which is I know is a widely followed ETF in your community, just recently passed 500 million in AUM. It continues to outperform the TSX 60 with a very attractive yield as well.
Yeah.
We just hit a 1 year anniversary mark for HBond, which was our covered call fixed income ETF. That's delivered a total return of about 13% since we launched it. Very nice yield of 10% and some tax efficiency. And then more recently, we just launched HBIL, which we believe is a viable alternative to cash accounts, HISA accounts, with just a modest amount of duration risk.
Yeah.
But very attractive yield over what you get from the risk-free rate. So HPIL is definitely worthy of attention. It's off to a great start. I think we've raised about just over 25 million in about 2 weeks. So we're quite excited about that to round out our fixed income suite of covered calls, which Nick can highlight a bit more and go into a bit more color as to why we think this is timely. But yeah, things are going great, and we're incredibly grateful, and it's an exciting time for all of us.
Yeah, these bond ETFs are getting more and more popular these days, especially with rates starting to go down now in the US as well. So maybe you could just, real quick before we get into all the questions with Nick, talk to me a little bit about how interest rates going down impacts these ETFs. Why has there been such a demand for these ETFs, the fixed income ones with covered calls?
Yeah, sure. I mean, I can speak a little bit about that. We've been waiting for this, easing from the Federal Reserve. It feels like for a while now, and they're finally doing it. They're finally cutting rates. Canada was a little bit ahead of them. So
Yeah.
in Canada, they started cutting rates a little bit sooner. But it definitely seems like the tide has turned, both in terms of rates and inflation. You look at the numbers coming out of China in terms of the inflation; those are very low. That's being exported back to the rest of the world. So you're really seeing inflation kind of topping out, and that's helping interest rates come down. Which, as your viewers probably know, as interest rates come down, bonds go up. Now, why is that very good for H bond or cover calls on bond ETFs? Is that you get the underlying going up, but you're also getting some volatility. We're getting a lot of volatility in the fixed income market still, much higher than we have over the past decade. And we can talk a little bit more about that. But we have a very good volatility environment where rates are moving around, and we have a Federal Reserve that's on your side, that's cutting rates and letting bonds go higher.
Yeah, I got a quick question for you because I think, including myself, I'm wondering maybe you have the answer to this. The Fed just recently cut 50, not 25, 50 basis points. Canada's been cutting. How come we haven't seen a spike with TLT? Is it because it takes a long time? It's a slow process? Is it because it's fixed income and it just works that way? We would, my audience and myself included, we expected a little pop with TLT or any one of these, fixed income assets. How come we haven't seen that? I think TLT didn't budge at all after that announcement.
I think it actually
You're
moved
right.
down a little bit, didn't it, Nick?
Yeah, you're right. It did move down a little bit after the announcement, and I think the market was really already pricing that in, and so we did see a big move in TLT from the mid 80s all the way to 100 over the past year, and I think that a lot of that move in TLT in the last few months was predicated on the Fed already easing their policy a little bit. So I think in a way TLT kind of front ran this decision a little bit, but I think on the other hand, there's going to be more, Fed easing. I think this is, Jerome Powell said this is the first step. I
Yeah.
think he basically said we're in easing mode. And, if you look at the chart there, you see that the trend's been up for TLT, even though it has come down a little bit. Over the past year, it has been up. And I think that, you have that tailwind at your back, which is slower short-term rates. Despite that, short-term rates right now are still higher than where long-term rates are for TLT. So you're going to need more easing to help TLT higher, but it's still going to overall be helpful.
Okay, that makes sense. Yeah, I like that was my impression when they this is something I've seen before when they talk or something is expected for such a long time, they're always talking. When it actually happens, it's a lackluster reaction. I
Exactly
think it's
right.
just
Yeah.
like human psychology. But I agree with you. I think it is TLT there is still a tailwind which helps fixed income. I'm assuming this helps the medium term as well, the medium term ones, the long
Yeah,
term
yeah,
ones as
and
well.
you're seeing that even in the 2-year rates. The 2-year rates have come down significantly. 2-year yields have come down significantly lower than where overnight rates are right now. So you're seeing that across the bonds, across the yield curve, and I think we'll continue to see rates come low, go lower as the Fed continues their easing.
Yeah. Okay. Well, this is why I'm happy to talk to you guys who actually look at all the years. I just look at TLT. I don't really do much analysis personally. So, Nick, let's talk about you a little bit. So obviously, you're the main man. You're the guy behind all the options, right? The covered calls. Obviously, you have a team. It's not just you writing the calls all day, but you're the boss there. So tell me a little bit about your background, your experience. How did you get into this line of work? I know we briefly talked about it in another video that you're a math background. So tell
Yeah.
me all about yourself.
Yeah, so I started the business over 25 years ago now, so I'm dating myself a little bit. But when I started, I had a math degree from Waterloo, and I was one of those quants, I guess you might call them. But at the time in the business, there weren't that many of us. If you think back at that time, algorithms didn't really exist. ETFs were just starting. There weren't really that many ETFs around at all. So it was very beginning of the business where there's more and more programmers, more and more quants involved in the market. And so I got in at the time, and at the time, basically they said, well, if you have a math degree, you have to go into derivatives. That's kind of that is the one area for you. So that's how I got my start on an options desk. And for the next 12 years or so, I worked on the sell side, which is I worked at a bank, and I managed a portfolio of options where I was kind of a market maker for clients. And so I saw a lot of covered call funds, even at the time, even though they weren't ETF funds, but they were covered call mutual funds or covered call closed-end funds, where they were selling call options, and I would be the one buying them and trading them in the market. And so over that kind of 12-year period, I got lots of experience trading in various markets. In that time frame, you had the Asian financial crisis, you had the tech bubble, then you had the global financial crisis. So I saw a lot of different kinds of markets, and but after being an options trader of managing risk for that long, it wears you down. And so a little over 10 years ago, I decided I needed to do some job where I could sit down and think and not look at every tick, every stock price move. I needed a job which is more of a portfolio managing role. And so over about 10 years ago, I moved into the portfolio management side of things. And my background really gave me a very unique perspective because I'd seen both sides of the equation. Not only did I understand obviously options pricing and volatility, but I understood how the buyers of the options looked at the world and what kind of options they'd want to buy and which ones were the best ones to buy or sell. And so coming over to the portfolio management side and as a covered call writer, it kind of gave me a new perspective now. I no longer was buying the options, but I was selling the options, but also how the buyers were looking at the same trade. And so having been on both sides of that equation as both the buyer and the seller, I think really gives me an edge in getting the best possible, execution. And so for the past, 10 years and now I Hamilton for a year and a half, it's been a great market for covered calls. That you're getting a lot of volatility, but you're also getting markets that are moving higher, and those are two elements that really help a covered call strategy.
Wow, what an awesome background. I like that you have both sides of the equation. Now, I heard that express, I've watched Billions twice. I love that show. In there, there's quants. They're typically, what is a quant? It's quantitative analyst, I believe. So, pretend you're
Yeah,
talking to a dumb person, explain what kind of role or what kind of experience a quant will bring to the stock market. I know they use math a lot.
yeah. So I mean, the quants in the market today, a lot of them are focused on algorithmic trading and market making, and so it's a lot of them have PhDs in physics, PhDs in math,
Holy
and
smokes.
yeah, oh yeah, they're really smart guys. And what they try to do, they try to model short-term movements in the price of securities, but so that's one role where they basically use their modeling skills and the quantitative skills to really extract a very small amount of money off buying and selling. Even if you've tried to buy or sell stocks in the markets today, you'll see as soon as you put in a bid on a stock, the offer will move right away, or there'll be a lot of movements based on the orders coming in and out of the market. And so quants really, that's what they've been doing for the past 15 years, is quantifying, taking over a role that was normally done by one trader on the New York Stock Exchange floor, trying to keep a balance between buyers and sellers. Basically, all that's been computerized now, and these quants are the ones who create all the models and the computer programs to run that. So that's one aspect of it. And then there's also other aspects now where they're using quantitative modeling for investing, for factor investing, for all sorts of different things. It's a very long conversation, but just to say that they've really changed how markets are traded in the past decade.
Yeah, I mean, when I first watched that season where they focus on the quants, I was lost. The second time I watched it, I understood a little bit more. But it's like you said, I think they focus more on building algorithms and models that, most of the time, sometimes focuses on short-term trading. Then let's find an inefficiency that will take a penny, half a penny off this transaction. But when you're doing it in the billions, it makes a lot of money. So anyway, thanks for
Exactly.
that. That's super interesting
Yeah.
stuff here. So obviously you got the background for options and which is all about math and things like that. So let's get into the details now. Hamilton's strategy, the option strategy. Let's get into the gut. So the first question I'm gonna have to ask you is: most covered call managers in Canada, and even in the US for that matter, they write out of the money calls, which means the strike prices are higher than the current price. But Hamilton took a completely different approach. You guys are, focusing, and this is really for pretty much all your suite of yield maximizer ETFs at the money call. So you're writing the strike prices are the same. Obviously, you're covering a little bit less. So why did you guys decide we're gonna go with at the money calls, not out of the money?
There's a couple of reasons, and I'll go through that now. And first, I want to give a little bit of a background as to because Hamilton launched we launched our max yield ETFs over the past several years, but covered call ETFs have been around for a long time in Canada,
Yeah,
over 10 years.
yeah,
And initially, the approach was out of the money, and the reason for that was because for the most part, people viewed the covered call component of the strategy as a small part of an overall investment. So you were buying a dividend fund, you were buying a bank fund, and you wanted a little bit of extra premium. And so because you wanted only a little bit of extra premium, you sold out of the money calls because they'll earn you, a little, not much premium, but enough to make a difference. On the other hand, you're benefiting from more of the upside, more of the growth.
yeah.
And what Hamilton identified was that people buy these funds because they want the income, not because they necessarily want more of the upside, or they're really buying these funds for the income. If they want upside, they could just buy a regular fund with no covered calls.
Right.
And so the revelation from our perspective was, well, let's just, for our funds, we're going to be income focused. It'll be income first approach. Instead of allowing that much upside, we're going to be writing at the money calls where you're sacrificing more of the growth, but for more income. And that's basically the trade-off that you're always making. You're trading off income versus growth. And I think the max yield approach is to focus on the income first, whereas most most ETFs previous to that, or even most covered call writers previous to that, were really more focused on a growth balance. But as as we get more and more investors who are looking for income, the income first approach makes sense. Now the additional reason is that at the money options, the buyers of the options that I mentioned earlier, I've been doing this for some time, and I understand the buyers of the options, they like at the money options better. They're willing to
Really?
pay more money for those at the money options because it allows them to trade them around. They know their risk. Whereas when the option is out of the money, they're not going to pay as much of a volatility level. You're going to have a bit of a skew to the option prices, and out of the money options is going to have a bit of a lower value relative to the at the money options. And so you don't have to write as many at the money options to get a really significant yield. You'd have to write way more of those out of the money options to get the same yield. So our approach is why, write out of the money options, we're going to have to write a lot more of them for that yield, as opposed to let's just write a little bit less and write them at the money.
No, that makes complete sense. And when you say writing more, the moneyness of the options is one component. The coverage is obviously the second one. And and we're going to talk all about this later, but besides HMAX and UMAX, I believe you're only recovering 30% of the
That's
portfolio. So at the money calls, but 30% coverage, whereas other providers, yes, they're out of the money, but they'll cover 33, they'll cover 50, or even more. So that's interesting. I didn't know it's easier to sell the ATM calls. That's super interesting. So do you write calls exclusively on individual stocks, individual companies, or indexes as well? We know that you could write calls on single stocks, you could write index SPX, NDX calls. So Hamilton has an approach where you're picking and choosing stocks for your portfolios. So do you write only on companies, indexes as
Yeah.
well, or not?
So, I mean, the first thing is, our underlying portfolios, where for each of the funds, that's a fairly, passive process. We own the largest companies in the sector with a good options market. So we try not to be stock pickers. We really just want to own the best companies, and generally the best and largest companies are the ones we're going to have the largest market cap. They're also going to have the best options market generally. So that makes it a nice you know, uh, attribute to those stocks. Now, in terms of writing on the individual stocks versus the underlying indices, because we don't actually own all of the indices themselves, it's difficult. It can be risky to write on the index, just because if the index goes down or up, and your underlying stocks are going to be highly correlated, but they're not going to be 100% correlated, and so you're going to have some risk between what the index does and what your underlying portfolio might do. So we just focus on the underlying stocks. In addition, by focusing on each of the underlying stocks, we can get more premium than if we just wrote on the index. Generally, index volatility is going to be lower than the individual volatilities of the stocks. And so you can earn more premium by focusing on the individual stocks. Because if you think about even just large tech stocks like QMAX, you're going to have NVIDIA, you're going to have AMD. These are large semiconductor stocks with quite a bit of volatility on which you're getting quite a bit of premium. But if you're looking at the index, all of these stocks kind of offset each other, and so index volatility might be quite a bit lower. So you're not going to get the same amount of premium. So we just focus on the individual names. That's plenty of premium for us to take, and generally it also means that we don't have to write as much. If we had to use the index options, we'd likely have to write more and have a higher coverage.
That makes complete sense to me. Perfect. Thanks for that explanation. What about the call themselves? Do you typically do or write a monthly, all monthly covered calls? We know that there's some weekly covered calls as well. There is daily, but those are just on indexes for now. So do you do exclusively monthly, or do you mix in weekly as well?
We'll mix things up a little bit.
Okay.
We will do some. Generally, we look at monthly expiries in the sense that every month we want to generate the premium that we're paying out to investors. But we don't want to have all our options expiring on one day, because that's, first of all, that could be a lot of work, but also it's a lot of risk. If on that one day something happens, you might get called away on more of the portfolio that you really expected. So it's a nice thing to be able to stagger those expiries. And so we'll use the weeklies for that purpose. On some names, we'll have them expire at different weekly expiries so that, you're not subject to just one day of the month where all these, and as you might have noticed, expiry day, which is the third Friday of every month, tends to be a pretty crazy day. It tends to
I've
have a
heard
bit of
that.
a higher, yeah, it tends to have a bit of a higher volatility. People are hedging, traders are hedging their positions on these options. There's a lot of gamma squeezes, if you've heard of a name like that. There's a lot of stuff going on at those expiry dates, which means that, sometimes it's not the best time to be buying back your options or writing new options or rolling options. So not only do we like to use various expiries, we hardly ever go more than a month though, because, you still get more premium by writing, monthly options. And sometimes we might go a little bit shorter depending on a situation, whether it's earnings or dividends or others. There's other situations where we might go a little bit shorter than that. We're constantly kind of the market's constantly changing. As you know, these covered call funds are getting bigger and bigger, and sometimes we have to adapt a little bit.
Yeah.
But on average, we think this is still a good strategy where, we're a little bit more active, but we're focusing on various kind of 4-week periods and extracting premium from the portfolio.
Okay, and do you typically let them go all the way till expiry? The 1 month options, for example. So, you write a 1 month call, it could be the strike price could be hit after a week or 2 weeks. Do you
Yeah.
typically just wait it out? Is there any circumstances where I learned this recently, you could actually roll over the call, just roll it over. So do you guys do that, or you typically just let them expire?
We generally so we do roll over calls, especially if they're in the money and we don't want to get called away on the underlying stock. So we will roll options. At times we will roll them a little bit early. So we might roll them before their expiry. If there's some earnings coming out or there's a dividend getting paid. If there's a dividend getting paid, we want to make sure we don't get exercised before that dividend. So we'll exercise, or we'll roll early before we get early exercised. There's always a chance when you're short an option and there's a dividend coming up that the holder of the option might exercise you early to earn, so he can get the dividend instead.
Right.
So there's situations like that where we will manage around that. But on average, we want to, the markets go up and down. So we don't want to be overactive in our trading and, rolling our options right away or trading too much, creating too much trading. So, I would say 80% of the time, maybe even 90% of the time, we'll hold on to our short options close to expiry, and then at that point we'll roll those options into new options. But there are exceptions, and one of the exceptions was actually, last month we had some of our options in the tech sector
Yeah.
that were way out of the money, and so in some cases it's really makes a lot of sense to buy them back, because you're buying those options back for next to nothing. Suppose you sold them for, as an example, you sold them for $10. If you can buy those back for 25 cents, you're only going to ever get 25 cents out of that option. So you might as well buy back for 25 cents, and then it gives you the opportunity to sell new ones at a later time, and extract more premium. So they're always, it doesn't happen very often, but there are times where you want to trade those options before expiry.
I'm hearing a lot of active management here. You're really doing a deep dive and looking and trying to find the best circumstances. I'm assuming the biggest bang for your buck in the fund, which obviously helps the NAV. This brings me to the next question. Do you write on every single stock in the portfolio? Is there a selection? Do you maybe exclude a stock that you're very, very bullish on for a month? How is that selection? How is that done on a month-to-month basis?
Yeah, I mean, generally we don't take very many directional fundamental views on any stocks. However, if we think that we're not getting paid the amount of volatility that we should be on any individual name, so for example, suppose on Apple, the stock's been moving up or down quite a bit, And I mean, this is an extreme example. Apple has very, very liquid options, so it will almost never happen for that name. But there are some names where, perhaps there's a little bit less liquidity in the market or in the options. And so the option buyer is not willing to pay you enough for that option. And meanwhile, he's paying you, he's willing to pay you quite a bit more for another name. So,
Right.
we might write a little bit less of the name where we don't think we're getting enough value, and we'll write more of a name where we think we're getting great value. So it's really about where are we getting the most value from our monetizing those calls. And it will vary from name to name, but there's certainly names where if there's not much interest in buying the calls, and you're giving up, as we're writing at the money option. So if you're giving up the upside for not enough money, it doesn't make sense to do it. And so we'll look at each name individually, and we'll decide, no, we're only going to do a little bit of this one or more of this one. At the end of the day, however, we still have our targets that we want to earn every month in terms of our premium.
Yeah.
And so, that does mean that we will write on most of the names at all times, but we can vary it a little bit depending on the circumstance.
Okay. Okay. Are your coverage ratios now? So, for most of them, it's at the money calls on 30%, some of them at the money calls on 50%. Is that really like set in stone? Is it fixed? Does that vary from month to month? How do you decide?
Yeah, that's a great question. And I think that's what makes our approach pretty unique, relative to some other strategies in the market, is we can vary our coverage according to market conditions. And so, as I mentioned earlier, when there's times where there's, maybe we're not getting paid enough on one name, or we're getting good volatility here, there's also times where market volatility in general will be very high, or market volatility in general will be very low. The market volatility, you can loosely look at it by looking at the VIX index. And, the VIX index will have big spikes. It'll also come down depending on the market environment. And so because we're targeting a certain amount of premium every month, we can adjust our coverage to match these volatility differences. Mm-hmm. So in a very high VIX environment where we get a lot of high volatility, that means that we're going to get a lot of premium for options. So we don't have to write 30%. Maybe we only have to write 22% or 20%. Or meanwhile, if the volatility comes down quite a bit, maybe we'll have to write a bit more. Maybe we'll have to write a little bit more, like 35%. But the nice thing about that approach is that it matches the market environment. In a market environment where you're getting a lot of volatility and things could move quite a bit, you don't want to have a very high coverage ratio, because you're going to give up more upside if things recover. On the other hand, in a lower volatility environment, things don't move as much. And so there's not as much risk of the stocks moving against you a significant amount. And so by varying the coverage ratio, we're able to adapt to these different market conditions.
That's awesome.
I might just add one thing in there, Adrian, for some of your viewers. If you looked at our website, you'll see different coverage ratios that we post on the website. So some of them will say 30%, UMAX and HMAX in particular. We have 50% listed. Two things. Number one, we back tested all these strategies over 10 years of historical volatility in options markets. So those numbers we're giving, a 50 or 30, are what we would expect in a normal market, volatility market. The reason there's some differences, so again, Nick has talked about how he can vary the coverage ratio, which he can do on all of them. But the reason that, for example, HMAX and UMAX would have a higher coverage ratio is that there's just more volatility in the US markets than there are in the Canadian markets. So for HMAX and UMAX, they're Canadian holdings, right? And so the volatility, the realities of volatility is lower in Canada, which requires a slightly higher coverage ratio than you would in the US. And so that's the main kind of differences.
And certainly it's also based on the sector. Canadian financials, a very stable sector. Canadian utilities, very stable sector. And so these sectors have lower volatility levels.
Yeah.
Especially when you compare them to tech, high-flying tech stocks, or like QMAX, or you compare them to gold stocks in AMAX. These sectors have much higher volatility, and because they have higher volatility, we don't need to write as much of the portfolio.
Yeah, and there's, I keep getting, I'm sure you guys do too, a lot of questions about your distributions, how you select those amounts. Some of them are going up, some of them are going down. We'll talk all about that in just a second. My last question about really your overall approach is a question I keep getting, and I didn't really get a super direct answer from other fund managers, but most of them just say it's not a problem at all. So I'm curious to know what you feel about this. There's a growing number, I would even say an exploding number of options ETFs, covered call ETFs, in both in Canada and the US. Is there a possibility that call premiums might get saturated? I don't know if that's a good term, saturated or less valuable because there's all these providers writing calls on all the same assets. I mean, who's buying all these calls, right? That's another
Yeah,
question I keep getting.
yeah,
Who's
yeah,
buying all these calls?
yeah. Well, it's funny because that brings us back to a little bit of the conversation we had at the beginning, where how do all these quants get involved and what do they do? There, there's a lot of hedge fund and quantitative investors who always look at the options volatility market versus what the underlying volatility underlying volatility in the markets are doing. And so there's always a bit of a, maybe not quite an arbitrage, but almost an arbitrage between keeping the underlying volatility more or less in line with where the implied volatility of the options are. And so as long as the underlying volatility stays elevated, that's going to keep the options market elevated as well. So for these ETF strategies to basically overcome and put so much pressure on the price of options, they would have to affect the entire underlying market and lower the volatility of the entire underlying market, which, even though these option strategies are growing, they're still a minute amount relative to all the trading that happens in the market on a day-to-day basis. And so because of that, I don't think that's going to be an issue for a very, very, very long time. And the second thing is the market's always evolving. Like, there's always new products. People are trading, as you said, weeklies and daily options now. A lot of those are buyers, and so who are taking views on the market, and so that's keeping the market option elevated. That's keeping volatility elevated. So there's going to be hedge funds who are going to be selling the dailies and buying the monthlies. At the end of the day, there's always going to be a certain level of volatility in the market, and so those strategies will keep being able to earn some premiums. Yeah.
Excellent. I'm learning a lot today, that's for sure. Let's talk about the distributions, right? Everyone's favorite subject, of course. Got to get my monthly dividends. That's obviously why everyone loves these ETFs. So tell me, how does Hamilton ETF set the monthly distributions? Let's focus on the yield maximizer ETFs. We talked about your all-in-ones, HYLD, HDIV, in the last video, I believe. But the yield maximizers, there's variances. Sometimes they go up, sometimes they go down. So for example, the HMAX, UMAX have been a little bit on a downward trend that is worrying people a little bit. Now they've actually reversed. They actually went up from last month. Then you have a lot of, like QMAX, it's on an upward trend, but they're not exactly, they're not skyrocketing up or down. They're fairly consistent still. So tell me about how does Hamilton set the monthly distributions? What's the policy?
Sure. Why don't I start, and Nick, you can chime in if I'm missing anything. But the biggest thing, I think, just to set expectations for investors, and I believe we spoke about this a little bit on our last video, is with the yield maximizer ETFs, they obviously have higher distributions. Our view is that it's responsible management to have some level of variability, right? So when Nick and his team, every month, there's different dynamics going in the market, in the options market, and volatility. The premium income that's incoming to the portfolio and dividends, these are variable numbers, right? And so we think it's responsible to have some variance to the distributions. We appreciate that most investors want to have like the exact dollar amount every month. Our view is, though, is any high yielding ETF with a fixed distribution, you increase the risk of NAV erosion in that case, right? Because like I said, the incoming income we're getting to the portfolio is variable. So we believe that the outgoing should also be variable. And so what you've seen just since all the launches and as we broaden out the suite, on average, if you look at most of the ETFs, they've gone up from day one to where we are today. But month to month, it's going to bounce around a little bit within a range. HDIV and HYLD, which I know are widely followed in your channel as well, there's a benefit to them as they have some diversification, right? It's a diversification of each of those individual yield maximizer ETFs. So in this essence, it diversifies away some of that distribution variability.
Right.
So you can expect those two ETFs, HDIV and HYLD, to have more consistent, I would say, in terms of the dollar value. And then the yield maximizers would have some variability within a narrow range.
That makes perfect sense. So it's not something investors should be worried about. There's something wrong with the fund. You don't want to overpay and you're paying an appropriate amount on the yield maximizer. Is it safe to say, Pat or Nick, that you guys will never overpay on a month-to-month basis? Can we say that?
Yeah, that's what we're doing. I mean, we have target yields that are listed on all the ETFs, except the ones that don't have a 1 year history yet.
Right.
We back tested these strategies, like I said earlier, over 10 years. Those are the yields that we feel quite comfortable with. We feel that they're sustainable. But in that back testing, there was some variability with it as well. So, like I said, we just think that's responsible distribution management. And that's the way that suite works. And then for the investors that want that exact dollar amount with less variability, I would say HDIV and HYLD would be a better solution.
Okay, and you kind of touched it on this already. What are the main differences between a fixed distribution and a variable distribution, pros and cons or whatnot?
Yeah, I mean, a fixed distribution is exactly as it's implied. It's taking, it's a management decision where they're saying this is going to be the dollar amount, and it has no variability over a period of time. Variability just means that month to month there's going to be some differences. Nick, I don't know if you want to add some color as to what.
Yeah, I mean, look, I think at the end, of the day, markets are volatile, and it's by having a fixed distribution, you're putting yourself in a corner where regardless of what happens in the market, you are forced to pay that exact distribution, which means that at times you're either going to have to a little bit too much or not enough. But it for us that doesn't seem like a clean solution. We'd rather just pay based on the dividends and the premiums that we earn. We think this way, if the markets go higher and we're earning more premiums, we can increase the distribution easily. And if the markets go lower, we can adjust lower the same way. It's a much easier way to adjust. Whereas with fixed distribution, what happens if the market's down and you're not able to earn the same amount of premium? When do you cut? Well, how often? What are you gonna do? It creates some issues.
Yeah, no, that makes
sense. Essentially, if you're overpaying on it, if you're stuck with a fixed distribution and you're overpaying, that's coming out of capital, right? So we're trying to do the responsible NAV-friendly approach, and so we think that's the best way to do it for a suite of ETFs that have higher yields.
Yeah, and I guess every fund manager is different. You guys have obviously your approach, and other fund managers have more of a fixed one. Sometimes they'll change it once a year or anything like that. But you guys have elected to really do it on a month-to-month basis, and like we could see, sometimes they go down a little bit, sometimes they go up, but they're not drastic changes. And you're very aware not to pay. I think that's the main message people want to hear. You don't want to overpay what the ETF is earning. So
that's 100% the rationale behind that strategy.
Okay, perfect. So I think we've covered really in depth Hamilton's view of options, Nick's background, distributions. These are things that are very, very important. I got some fun questions that I want to ask you. I mean, personally here, I'm sure my audience will agree with these questions, and then maybe we'll take a couple of members' questions. So there's an explosion or emergence/explosion of zero DTE options in the US. So there are zero DTE, options that expire in 1 day. Right now, I think it's just on the 3 major indexes in the US, the S&P 500, the NASDAQ, the Russell 2000. I did speak to a couple of fund managers in the US. I know that the SEC is actually looking into implementing maybe daily options on other things, a big liquid ETFs or stocks. So what do you think about these types of options? Is it something you guys are looking at to implement maybe for future products? I know you can't talk about future products, but do you have an opinion or thoughts on these?
Well, I can talk a little bit about that market, and let me tell you, nobody is more surprised than me as to how big and how quickly this market has developed. I remember when they first launched these 0-day expiry options. We kind of looked at them as something kind of fun on the side where people could take a view on what the market was going to do the next day. And but I didn't think it was going to be much more than that, and it's turned into a big amount of the volume that's traded on the exchange, with lots of activity, lots of volume. And so the market makers love this, by the way, because they're seeing a lot of volume. the clearing corporation loves this because they're getting a lot of fees. But from our perspective, we really have to decide: is it worthwhile for us to pay commission 250 times a year to trade these, as opposed to 12 times? There's a bit of a higher bar in terms of, is this going to be a viable strategy, for investors? It might be a viable strategy for, traders or one-off people to take a view. But we have to think about whether that makes sense from an investment point of view, because it's a lot more trading. There's a lot more risk of, are you going to trade at 4 p.m.? Are you going to trade at 3 p.m.? Are you going to trade at noon? Like, when are you going to trade them? And then you have to buy them back or let them expire. And then when are you trading the new one? There's a lot of work that needs to go into making sure that these run smoothly. And you got to, every time we trade an option, there's a cost involved. There's the commission, but there's also the bid offer spread.
Yeah.
And if you think about that, you're multiplying that cost by 10 times relative, or 20 times relative to if you're doing a monthly. So you got to make sure you think through all the scenarios correctly, and make sure you know exactly what you're going to be doing before you execute a strategy like that. So it's no doubt interesting. It certainly exceeded my expectations in terms of the kind of market it's developed into. And it looks inevitable that these daily options are going to expand to single stocks. So I'm sure that's going to happen. It's already, we already see them in assets like TLT, which is the asset that we use to trade options on H bond and H bill. So they're certainly here to stay. But the verdict's still out on whether I think you can make a good long-term strategy out of it.
Interesting. Yeah, I'm a big fan. I like them. I mean, I think they're very interesting. Obviously, they're gonna have higher costs, and you could kind of see that in the fees. But there's a lot of providers that have launched different type of strategies. Do we do it at the beginning of the day? Do we get the overnight exposure? We don't. So I feel like there's still a little bit of hashing out, but some of them have been very, very successful, outstanding returns. So it's
Yeah, I
interesting
mean,
to see the future.
it's certainly the liquidity is there for these strategies. I mean,
Yeah.
as there's a lot of volume for sure.
Yeah, and that reminds me of a question I actually forgot to ask you, Nick, about, the covered calls. Do you do weekly? Do you do daily? It's not weekly or monthly, let them expire, etc. Do you guys ever do call spreads, or you just writing your classic covered calls? Is there any circumstance where you do a spread? And in
Yeah.
case my audience doesn't know, you're selling a covered call at one strike price, let's say, at the money, but you're buying another call at a higher strike price.
Yeah.
That's the spread.
Yeah, no, I mean, generally, we definitely never do spreads. We always do just one call rate.
Okay.
One of the reasons that we don't do spreads is, well, first of all, it's, the industry, at least in Canada, has never really looked at spreads. It's really only looked at doing, one option. There's some extra costs again, unless you're looking. The thing is, if you're trading an index option, or you're trading a very, very liquid asset classes, then spreads can be a very viable strategy. But as soon as you get away from the super liquid like indices, spreads then adds an extra layer of trading costs, because you're selling one option, then you're buying another, and then you have to unwind that trade later on. So you're adding trading costs. That might not be substantial when you're looking at very, very liquid asset classes, but as soon as you're looking at Canadian banks, or as soon as you're looking at Canadian utilities, or as soon as you're looking at even some of the not as big names that we own in some of our portfolios, trading spreads then adds a level of cost and complexity, and I just don't think that it's worth doing it for most of the time. But certainly on very liquid indices and very liquid underlyings, that is something that could work.
Interesting. Okay, cool. And final question before we take just a few member questions. It's been over an hour almost here. HDIV, HYLD, or HYLD, they use 25% leverage, which is, seems to have really benefited their overall performance. I think that much is obvious. So with interest rates going down and they've been historically really low compared to, I don't know, decades ago. Why not push the leverage higher to maybe 33 or 50%, or maybe have another product with the same product but a higher amount of leverage? I think a lot of people would be interested in that. And when I say a lot of people, I mean me. So what do you
Um,
guys think about that?
with HDIV and HILD, I mean, we also have HCAL, HUTS, and HFIN. We've done
25, yeah,
work on
yeah.
these portfolios, and the call it the Goldilocks amount of leverage, in our opinion, looking back over many market cycles, 25% was the right number that we were comfortable with, that we think, the average investor would be comfortable with, both from a volatility perspective and just like, a long-term capital perspective, right? Leverage can work against you. If you have too much leverage in a down market, it's sometimes very hard to overcome that when things start to rally. So 25% really is the sweet spot in our opinion. It's not to say that we would never launch versions with higher leverage. Time will tell, but with those products that we have, we're very comfortable with the 25% number. Like, we've done a lot of work on it, and that was really the sweet spot in our opinion.
Yeah. Yeah, that makes sense. I'm assuming you guys back test everything, but yeah, I mean, yeah, it's interesting. There's most of all leveraged Canadian covered call ETFs have 25%. There's only one that uses 33, and it's been going pretty well. So we'll have to see.
Mhm.
But yeah, it's definitely something. I get questions. We're not talking about those daily 2x leverage stuff. You know what I mean? Those are pretty
No,
crazy. That's for
definitely not.
trading. But if you're a long, I'm speaking for myself here. I'm a long-term buy and hold investor. I'm going to hold HYLD for probably the rest of my life. So these are quality blue chip assets with covered calls. Why not have a little bit of leverage, a little bit more leverage, a little bit more yield, potentially more return? That's just the way I see it. But all right, cool. So I got a couple of questions now from members, from paid YouTube members. And of course, I'm talking to my audience here. If you're interested in becoming a member, hit that little join button and check out the benefits there. But I'll share my screen here. Some interesting questions. I chose the ones that really got the most votes up. So first question is from Project Overload. Will Hamilton reassess HMAX and UMAX to align their covered call percentages with the other maximizer funds like SMAX, QMAX, and RMAX? And we kind of touched a little bit on this. So we know that UMAX and HMAX write at the money calls on 50% of the portfolio, whereas the other ones, it's 30%. And he's asking, because it could have more upside potential. What do you guys? What's your thoughts on that? On the HMAX and UMAX?
Yeah, Nick, you can come in after this in a second. I was just going to say, so remember those numbers, like the 50% and the 30% that's for in normal markets. I would say even with HMAX and UMAX, there's been times when their coverage ratio has been quite a bit lower in higher volatility periods. So if you remember when there was a regional banking crisis in the United States, the coverage ratio on HMAX was what, Nick? What were we at during that period of time?
It went down to low 30s, almost 30, even below 30%. I think. I don't remember exactly. I think it was like 29 or something like that.
Right. So there's a lot of flexibility there, but the reality is when you have these, HMAX and UMAX are all Canadian stocks, it just doesn't have the same volatility that you have in the US. RMAX, which your follower here noted too, has a lower coverage ratio because half the portfolio is in US stocks as well. So there's just the reality is just there's more volatility in the US that allow for lower coverage ratios.
Okay.
Yeah, I mean, I think that's the right answer. In that, when you're looking at HMAX and UMAX, you're looking at sectors that just have less volatility. So if we were going to lower that coverage to 30%, we'd have to lower our distributions, by the same amount. From 50 to 30, we'd have to cut them. And we think that 50% works for those sectors because they don't have as much volatility as the tech sector or as energy or large cap US names. So yeah, we're not going to be changing that anytime soon.
But there's implied in that question too. If you look at the performance of SMAX, QMAX, FMAX, because of their lower coverage ratios, we're able to get more upside. They've done phenomenally well.
So the last part is this question. I think that's a discussion they're having with another member here. Why not adjust UMAX and HMAX to have a bit of leverage? If you add that 25% leverage to them, hypothetically, maybe you could lower the coverage ratio. So I think we talked about this in the past. All your yield maximizer ETFs, these are non-leveraged.
Correct.
So why not add 25% and maybe lower the coverage ratio or launch leverage versions in case investors are interested in a leveraged version of HMAX or UMAX.
Yeah, we wouldn't be able to add it to the existing strategies. That would require a unit holder vote because the prospectus is based on there's no leverage based on the prospectus. So we'd have to launch new products. Like, we've talked about this before. We have ongoing product development discussions, and this is all good feedback that we listen to and discuss. So no promises, but we have an active dialogue on these things.
Okay.
And in the meantime, we also have levered versions with no covered calls, with the HCAL, HFIN, HCAL, which is 25% of levered banks, HFIN, which is 25% levered
That's
financials,
true. Yeah.
and HUTS, which is 25% levered utilities. And so you can combine that into your portfolio. If you think UMAX or HMAX isn't giving you enough upside, you can combine a little bit of those into your portfolio as well. Give more upside, and you're only sacrificing a small amount of yield.
That's true. And HFIN, HCAL have been ripping like crazy because there's no covered calls and there's a little bit of leverage. And that's why I like HDIV a lot, because and it's very unique. We talked about that in the last video, which was an HDIV 3-year anniversary. You got HFIN and HMAX. You have HUTS and UMAX. You have the growth. You kind of already did it for us by adding them in HDIV. So that could be another great option.
Yeah, those are great strategies, because if you think about it, the yield, you get a yield enhancement too on them. And you get a yield enhancement that's equivalent to what you get from some of the more traditional covered call ETFs that were launched a long time ago, right? So you're getting a boost, to the yield as well.
Yeah.
There's no upside cap.
Yeah, and I think HDIV's performance speaks for itself, right? And now we have 3 years of data. It's been great. It's been outperforming the TSX 60, which is the majority in part of Canadian financials.
And there's also there's a benefit too of like HDIV and HYLD are our two levered covered call ETFs. The fact that they're diversified helps with the leverage too if markets are falling, right? Versus a levered strategy just on a single sector. Having some diversification of those strategies helps a lot.
Yeah, there's definitely less risk than an HMAX with leverage, or UMAX, because you have sector specific risk. I like to call it for sure.
For sure.
So the next, there's a bunch of questions in here. So some are more difficult to answer. Some of them are a bit funky. I don't know if you even know who Ben Felix is, but one question that I get a lot, and less so because there's more education. Fund managers have videos on ROC. It's ROC, return of capital, right? When a dividend is classified or a portion of it is determined as ROC. How do you know if you're getting good ROC or bad ROC? Because like we've discussed many times, just because it's ROC doesn't mean it's bad. I don't think there's actually a way scientifically, an easy way, let's say, to know if ROC is good or bad. Would you agree with that? Any comments on that?
I mean, it's hard to distinguish for an investor to distinguish it when you look at the financial statements.
Yeah.
But this is a good question, and it flows well with your original question about our distribution policy, right? Like bad ROC comes from when you're taking it out of capital. So if you're overpaying, that's why we have some variability. So we're to avoid overpaying, right? Where we're what comes into the portfolio goes out. But what everyone should take note of is with any covered call strategy, if you go back over time, look at some of the oldest covered call strategies, return of capital is a prevailing theme. Like it's something that you should expect. There's also some tax efficiency to it as well. But
true.
There's the good ROC is essentially where Nick can offer a bit more color on this too. But at times you might have losses on the option strategy on a monthly basis, and they're offsetting gains in the portfolio, right? And then there's a recharacterization for tax purposes, which that basically alters it to return of capital. That's what they call good ROC. But it's limiting, like avoiding the bad ROC is what we do through our distribution management, having some variability, in our opinion.
Right. Well, the fact that you say with certainty we're not overpaying, to me, my personal opinion here, that's literally what you're saying is there is no bad ROC because we're not overpaying. Bad ROC to me is the fund is overpaying consistently. And another indication I would tell my viewers is look at the total returns. That's really the story, the real story of ETF, not just looking at the ROC or the capital, the NAV, which is the next question. In my world here, in the income world, there's a lot of negativity or a lot of terms being thrown around, and the most popular one is NAV erosion. I hate that term. I made videos on it calling it a myth. Obviously, it could exist in a certain way. I like to think of it more like capital decline, not NAV erosion. What do you guys think of this common misconception and criticism of this style of investing, the income style of investing?
Nick, do you wanna talk about that one?
Yeah, no. So I mean, in terms of these products, I mean, these products, people are buying them because they want the income, and so we're paying, the dividends on the underlying portfolio, we're paying the premiums on the underlying portfolio. So from that perspective, there really isn't any NAV erosion. You're just getting, as the markets move along and you're selling calls in your underlying portfolio, you're getting those premiums. But of course, you're not getting the full upside of the underlying portfolio because you're selling these calls.
Of course.
So in lieu of getting, the upside on that NAV, you're getting these premiums that we pay, on a monthly basis. And so when you're looking, you can't really look at it from a NAV erosion point of view. You kind of have to look at it from a total return point of view, like you mentioned earlier.
Of course.
Your return is still done well, and you're still getting a good total return, but it's just you're getting it in, tax efficient distributions. You're getting that return paid to you on a monthly basis.
Yeah, I think the key thing is what type of investor are you? Or if you're a growth investor, then covered calls may not be the solution for you. But if income is desirable and it's part of your overall financial plan and what you're trying to achieve, then these are great strategies for you.
Yeah. Yeah, and there's more and more of these cover call ETFs that are doing just fine in terms of total return, also, if not beating the
True.
underlying index, HYLD, hint, hint, everyone. So, Ben Felix, I don't know if you know who Ben Felix is. I think he's a guy who, he's got a popular YouTube channel, and he basically, if I I could be wrong here, just buy index funds. Anyway, common phrase, all yield chasers will get burned. What is your reply to that? My reply is I'm doing just fine, and the only time I get burned is when I don't put my sunscreen. What would you say to that line? All yield chasers will get burned. Another common criticism or a misconception people throw at high yield or income investing.
Listen, I just think that sounds like someone who just isn't prioritizing income. There's a big portion of the population that requires income, whether it's in their life stage or just their situation. That's something they're trying to achieve. And if you look at the total return over time, that should be your guide. We think we have a nice balance. We don't think our ETF should be like the entire part of people's portfolios. But if it's income they're looking for as a percentage of it, we think we can help at the end of the day.
Yeah. Yeah. I mean, I think it is possible you could get burned if you're yield chasing. I think that is a possibility. But again, you have to look at your objectives, the fund, the total returns, et cetera, et cetera, et cetera. Last question, guys. And I guess this is really more for Nick. Do you invest, Nick, in Hamilton ETFs? Do you hold any personally? Pat as well. This is a good question. I'm just curious, I guess.
Yeah, it's a great question. And our max yield is really made for people who are really focused on income, really want income, really need income. I have a full-time job that takes 150% of my time, so I don't have as much of a need for income. But the one I really like and the one I do own is H bond for the fixed income portion of my portfolio. Yeah, and because you still need to have a nice balance between equities and bonds. For the equities, I'd rather have a little bit of uncapped upside with less covered calls. But on the bond side, I feel like, well, I just own them kind of as a bit of a diversification hedge. So why not get a little bit of extra income from that part of the portfolio? And when we launched H bond about a year ago, we were the first ones to launch a fixed income covered call ETF, and that asset class has exploded. And so it's done very well both south of the border and here in Canada. And I think part of the reason is it really rings true. Investors need to buy more bonds because as they get older, they need to allocate more to their bond portfolios. But on the other hand, maybe getting 3.5% isn't enough. And so by monetizing the covered call premiums on the long bond, which is what we do in H bond, we're able to help with that part of the portfolio, which for a lot of people is a big part of their portfolios. So I like H bond for that reason. The second reason I really like H bond is, fixed income volatility has been very, very low in the last 10 years because of quantitative easing until about 2 years ago when they started raising rates. And so because of the new regime that we find ourselves in with the Federal Reserve now that was tightening, probably over tightened, now is kind of easing back into a lower rate environment. First of all, you're getting the tailwind from the lowering rates, which we talked about earlier in the show. But also, what we didn't talk about as much is the fact that interest rate volatility remains quite high and much higher than it has been, on average over the past decade. And so I really think that this is a new kind of asset class, new product class on the fixed income side, and so that's one of the ones I like the most and that I own. Yeah.
Interesting. Interesting. You think now with rates going down and maybe easing coming, you think volatility will start maybe dropping off in the fixed income world?
Yeah, I mean, maybe perhaps a little bit, and it already has started to come down relative to where it was, maybe a year ago. But it's still, I was looking at it before we just did this recording, and I realized that the MOVE index, which is a measure of interest rate volatility, is actually higher today than it was for most of the period between 2012 and 2021. So it really shows you how high the interest rate volatility is today relative to where it was in the past.
It's interesting perspective. Interesting perspective. Awesome. So, guys, you've been with us a long time. I really appreciate your time. I know you're busy, so you guys are a community favorite. Obviously, you're doing very well. You're hitting milestone after milestone, not only in total AUM, but your funds as well. So, looking forward to more products, more milestones. And if you guys want to have anything to say to the community, go ahead. I am pretty much out of breath now.
No, we always appreciate it, Adrian, and I say this every time, but I think your channel is very important. This covered call industry is evolving every day. There's new funds, there's new things for people to look at, and you're making it accessible for everyone. You're giving them the information and arming them with the information they need to make the right decisions. And so I think it's a very valuable service. And yeah, we appreciate our ongoing partnership. And obviously we have a very strong following from your channel as well, and we appreciate everyone being part of us and our growth.
All right, awesome. It's good to put the faces behind who's managing these great products that a lot of people are reliant on for their income. So yeah, I'm just showing people what I do and trying to educate people how these funds work and talking with the experts behind them. So again, appreciate your time, appreciate the kind words, and of course we'll do this again. I'm sure we'll talk soon. Thanks, guys.
Hey, Adrian, thank you.
Have a good one.
Thank you, Adrian.
Bye-bye.